Okay, hi everyone. Let's take a look at problem 13-4A, which is an analysis of changes in stockholders' equity accounts. Now, I'm not going to work all of this problem, and I also have the screen resolution turned down, or the vision turned down for pretty small font. But that's because I have a lot to show on the screen, and I think it makes sense for us to see it all in one shot. Okay, what I am going to concentrate on is just this ending portion right here. This ending question that says, how much was net income in 2009? Okay, now, to the left of my mouse, they give us the beginning retained earnings, which is 320,000. And then they give us the ending retained earnings, which is 420,000. And I'm going to drop that in right here, in that cell and that cell. And then they give us a number of transactions. And the approach I'm going to use to solve this problem is to use the T account in retained earnings and try to figure out everything in there. And then if the only unknown is net income, we can solve for that. Now you see that I have solved this ahead of time, but let me illustrate my approach. Okay, the first transaction is the company declared a 5-cent cash dividend on January 5th. So if we know how many shares they have, right, 45,000. So if we just do the math here, we take 45,000 times 50 cents, and we can determine how much that first dividend is. Okay, so we jot that down, and we make this entry debiting dividends declared, or you could debit retained earnings directly, right? Either approach is fine. I'll talk about that a little later. And we've got the first entry taken care of. Okay, now let's take a look at the March 20th entry. To the left of my mouse, we purchased treasury stock for cash. Well, they tell us at the end there was 4,000 shares right above my mouse put into treasury, and the cost is $40,000. There's no other entries for treasury stock, so I can reasonably conclude that on March 20th, this entry right here was made, a debit to treasury stock and a credit to cash. Then on April 5th, to the left of my mouse, we declared another 5-cent per share cash dividend. And so now what we need to do is account for the fact that we have 4,000 less shares outstanding. How did I come up with that? Above my mouse, we had 45,000 shares to start with. 4,000 went in treasury, so we must have 41,000. Okay, and there's the math. 45,000 less 4,000 gets us 41,000 times 50 cents per share gets us a dividends declared of $20,500. Okay, no surprises on July 5th. It's the exact same transaction. So this takes care of that transaction for July 5th, which is the same one as well. Okay, now the next transaction we need to consider is the July 31st one, where we declare a 20% stock dividend when the stock market's value is $12 per share. All right, so how do we calculate that? Take the 41,000 shares outstanding times 20% to come up with the number of shares that are being issued, right? Then multiply that times $6, and that gives us the common stock value. Then we do the same calculation for additional paid-in capital, but this time the $6 that we're using to multiply times the 41,000 shares times 20%, which you can see elements of right here, but not all of the calculation, is representing the difference between the $12 per share price and the $6 above my mouse par value. So once we have that, we debit stock dividends distributable for the sum of those two amounts, or you can debit retained earnings directly, and that takes care of that transaction. Okay, now the last transaction we need to take care of is how we declare 50 cent per dividend per we declare a 50-cent per share cash dividend on October 5th. Sorry, I butchered that sentence there. In this one, the only thing that makes it tricky is that now our shares have increased. So we had 45,000 shares, just to sort of walk through it. We had 45,000 shares. We backed off 4,000 shares from Treasury, right? So that gave us 41,000. Then we had a 20% stock dividend. So if we multiply that times 1.2, we now have 49,200 shares. If we take the 49,200 shares times 50 cents, I'll just make it times 0.5, we come up with 24,600, which is how I got these dollar amounts right there. Okay? And we declare the dividend at this point. All right, now, once we have all of that, we can start working on the T accounts up here. Okay, now if we look up here, we can see how we can use that information to solve for the unknown. We began with 320, we ended with 420. All of these entries that we looked at below decreased retained earnings. So what we need to do is solve for the unknown, and we have all the others. So just using math, we take the beginning less the ending, and then subtract out all those debits, and you can calculate how much that credit needed to be in order to equal the 420, and that credit is net income. That's the only thing left there is for us to solve. Okay, so if the beginning was 320 and the ending was 420 and we had these entries, we can mathematically prove that number. Let's show how we can do that a more simpler way. We start with 320, we back off these amounts here, and if net income is what I think it should be, then when we sum we should equal the 420. And if we do, then we work the problem correctly.